One of our portfolio companies had 5 term sheets within a week. And it was great because we got in a call with the board and it was very clear to them which VC they wanted to go forward with. For me, the best outcome is having multiple options at the same time so that you can really go back and negotiate. Timing of your intercalls and timing of when you release the data room, I think two tactics that are it's kind of like the only things that you can control from a timing perspective. After that,
Hey, Camila. Thank you so much for joining me today.
thank you. Thanks for having me. It's a pleasure.
So, you recently shared with me how few of your portfolio companies had really successful fundraise, receiving 4 to 5 term sheets within the same week. So, what was more interesting to me was the point that you made that a company performing well does not guarantee the best outcome in a fundraising process. Why is that?
Yeah. When we talked recently, we were talking about like what are the subjects or topics that we could cover. I think one thing that recently stuck to my mind, to your point, is that we had 3 portfolio companies that had very successful fundraising rounds. Yes, they were a company that they were performing well, hitting their milestones, has shown growth. So we knew they would be able to raise. To my point is there's so much capital out there. There's so much dry powder in venture funds out there. So if you are a company that is performing well, is growing, has a good team, you most likely will be able to find an investor and will be able to raise a successful round. But when I say that it's not guaranteed the best outcome, is because ultimately what you want is many term sheets around the same time to really increase your odds, increase your negotiation power, right? So founders typically will focus, and that's not wrong, right? They focus on the strategy, on the purpose, on the overall story of the company, showing how they're doing great. And it's easy to forget the a crucial step of like really planning your fundraise in a very structured and efficient way to try your best. It's really hard to do, but really try your best to time when your lead potential lead investors are going to put that term sheet in, because you want them around the same time. So just taking a step back, because I know a lot of your audience are founders, but for those who don't know, the term sheet's kind of like an offer to invest in your company. You will have, it's a little quick legal document. Will have like the main terms that investor care about, so there is no surprise later on the full package of legal documents. There will be the evaluation, and it's pretty much the investor saying, like us at Grand Ventures saying, hey, I'm willing to put this much in your seed round or in your Series A round. I'm going to lead with this check, etc. And at the end, it has a timing, it has a deadline that you have to provide an answer.
Yeah.
So that's when it becomes interesting, because you want to time that so you have many of them at the same time, so you don't run the deadline from other investors. So you, with that, you allow yourself to have more negotiating power, because you see many offers. You can see what's a fair value, what's the market's willing to pay, the kind of like the range, the different terms. So the reason why I say why good companies don't necessarily have the best outcome is because for me the best outcome is having multiple options at the same time so that you can really go back and negotiate. And sometimes they don't. If it wasn't timed correctly, you get a term sheet and you're like, what are you going to do? You have one here, and some that might like in a month from now, but are you going to risk not signing for someone else that might drop along the way? So that's where the best outcome comes from.
Yeah. Yeah, this is so true. So I was helping a startup here fundraise, and then we decided to meet with one of the investors just to get a sense of whether that VC would be interested. But then we didn't expect the the VC to quickly give us a term sheet, and then it was like, okay, oh, now we didn't plan through. think through the entire process and have any other investor meetings lined up. So even when they offered the term sheet, it was like, okay, is this the best that we can get? We could not have an answer. So I guess having multiple term sheets is the only scenario where you have the leverage in negotiation, right?
I don't know. I mean, you have more leverage, right? I wouldn't say that now the startups that only have one term sheet are in a bad situation. You got a term sheet, that's already exceptional, right? Um what I would say, just like in a job search, you can still go back and negotiate, right? You can
Yeah.
still go back to that potential investor and say, hey, I was hoping for a little more of an valuation because I don't want to get very diluted. Or there are other places that you can negotiate too. You can negotiate in certain terms. You can negotiate maybe in your size of your option pool. Normally, investors are reasonable, and hopefully, you are getting one that is reasonable, especially if the company is doing well. And then, in some cases, even an investor might be able to extend that period. You can say, "Hey, I have a few other conversations that are at the end of their due diligence process. Can I wait one more week? Can you give me a little more time?" And sometimes they will let you do that because they also want to play nice. They want you to pick them, and that's a sign of like the quality and how you guys will work together in the future. And then that's when you can go back to other investors that have shown more seriousness to pursue the investment, to say, hey, I have a term sheet. How quickly can you make a decision if you're moving forward or not? And you can get a sense there before giving an answer to the other, the main lead investor that you have on the table. So it's not the end of the world, obviously, but it is much nicer when you actually have it, several term sheets in your hands, and you can quickly go back and forth and push back on some of the terms. So in our case, for example, we one of our portfolio companies had 5 term sheets within a week. And it was so great because we got in a call with the board, and it was very clear to them which VC they wanted to go forward with, as far as just like the quality of the conversations they had along the way, the team, everything, the whole process, right? But they had actually the second to worst valuation out of the 5. But with all 5 options, we were able to go back and say, hey, we really want to partner with you. We loved how you did this, and this. If you can come here to this valuation, you're going to make our lives much easier to decide.
Yeah.
And that moved the needle very quickly because they came up on valuation, and they were able to get the best valuation with the VC firm that they wanted, and only because they could compare things, apples to apples, and use that as leverage. I think one thing also that it's it's interesting and it's important to remember is, for serious investors, leading around it's a big process. It's a
Yeah.
heavy lift.
Yeah.
You have a lot of team members involved. You go through at least at our firm, like, you go through extended, comprehensive due diligence. You talk to customers, you talk to experts, you talk to other investors, you talk to the team at the startup, you do background checks, you do all these kind of things. And it takes time. It takes time from other investments that you could be doing because you're heads down doing due diligence in this specific company. So when you do put a term sheet, you want that term sheet.
Yeah.
And it's almost like a combination of like, hey, I just wasted all this time. I don't want to lose it because our term sheet's not the best. Or there's an ego thing in the VC industry. Like, what? They picked someone else. They didn't pick me. So again, when you do have multiple term sheets, you have that power to, pick between different ones. But most likely they all know that you're going to go back and try to negotiate. It's just like nowadays when people are, again, going back to the job hunt analogy. most likely someone's gonna get an offer and be like, "Oh, can I negotiate here?" It might not be in the salary, but it could be in the bonus package. It could be on the benefits. It could be in the flexibility from working from home. Whatever that is, there are different ways that the startups can negotiate that as well. So when you go back to that, whatever VC you like the most and say, "Hey, I got valuations that are much better than yours, but I really want to work with you." There is room for them to go up, most
Yeah.
likely. So I will keep that in mind. And again, and nobody want to lose. Like if they made the bet on that company, like for example, we looked at 1,000 companies a year. If we made a bet on like if the few that we actually put a term sheet in, we obviously want that very much. So take that in your favor.
Yeah, yeah, you have leverage even if you just receive one. It's exactly like you said. Like when you get an offer, the company has spent so much of effort, then there is a lot of sunken
Mm.
cost, and then there is little bit room for negotiation for sure. But you mentioned the different terms, right? When you say best outcome, what does that really mean? Is it just higher valuation or some other terms, or you get to pick the partner in a particular VC firm who you think might be the best fit or the right person for your business to work with? So, how would you define the best outcome?
That's a great question. I think it will vary company by company. For me, the best outcome is a combination of a VC firm that will provide the capital, obviously, but also support in different ways. It could be that you already have a board that is very sector focused and adding someone that now actually brings a different type of expertise. And it could be like a VC firm that the expertise for them is go to market strategy, is it's something very specific that that VC needs at that moment. So finding that VC that is willing to help, is willing to add value beyond just the capital. But I think what's going to be the best outcome, it depends on the specific need of the company. And of course, you don't want to get diluted too much. You want a valuation that is fair, especially when you have multiple term sheets in hand. You can say, "Oh, wow, this company here, they're so low. They're very price sensitive. It's not the right fit because I can have three others that are putting their price range over here on the top, and this one is much lower. Most likely, they're not going to be able to meet a huge gap. But again, maybe that firm has a ton of strategic value to add and it's going to be more beneficial to the company. So I think it's going to depend in each situation, and it's a conversation that the board, the executives can have together to help make that decision. But for example, one of the companies that I mentioned to you, what really drove them was the culture fit. It was the more like how they worked through the due diligence, little things along the way that really impressed the founders and said, "I want to work with these people. I love these people. They get us, they get our style." And that was way more important than the valuation. They were willing to take the valuation lower, the terms. Now, obviously, if they came with very unreasonable terms and valuations, it's a different story. But no, they came somewhat in the range, so they were willing to work with those VCs regardless. And then by having multiple options, they also able to go back and say, "Hey, make it a little easier on us. Like if you could increase valuation a little more, it would make this decision really quick and easy." And they were able to. So yeah, it will depend on each specific situation.
Okay, so in a situation where you receive one term sheet and a situation where you receive multiple term sheets, what would be the delta in in the outcome?
Yeah, are you saying for in terms of valuation or in
Just
other?
all the other
Yeah, I
factors.
think it could be very significant. I mean, again, you don't really know because you only got one term sheet, right? But like
Yeah.
it could be, if and we can talk about later strategies on how to try to time. Again, I said it's really hard, but when you only have one option in your hands and you're like still meeting people from intro calls, like it's so early in other conversations that even if a new firm show some interest, it's like, oh, I really like this, that interest could drop significantly 2 or 3 weeks from now. Like you could have an intro call, a second call, a third call that's really good and nice, but then you go to the investment committee and one of the partners absolutely hates it and then kind of like get cold feet about it. Or you are really digging deep and you say, like, let's say Green Ventures put a term sheet and they have two other firms that is much also further in the process. Like they're talking to customers, they're doing this, they're like in deep due diligence, and they say, okay, well, I'm not going to take it, I'm going to wait because maybe that firm's a little more well known. But then something may happen, they have a call with a customer and again get cold feet, or they have a call with an expert that they respect a lot, and that expert like points out a competitor that could be doing well, and that firm also drops out. So last thing you know, you passed on a deal, on a potential term sheet, and now those two other firms that had shown so much excitement literally out of nowhere decided not to pursue. And now you don't have any term sheet in hand. So it's hard to know the delta because you don't know what you could be getting in the future, right?
Yeah.
So that's why you want to bring as much control of the process early on, the intro calls with the data room release, so that you can try to get the interest parties along the same timing almost.
Yeah. Yeah, I would love to know how to do this really well. But just before that, this only applies to companies that are doing really, really well, right?
I wouldn't say really, really well. But yes, this process, like getting multiple term sheet in within a certain time frame, it typically means that you were able to dictate a little bit the process. And when you and to do that, you need to be in the upper position of like, I'm a good company, I'm at least good compared to what's out there. Because then you can like go to the investor and say, hey, such and such is in this stage. So then the other investors start moving faster, so you can control a little bit that way. But I wouldn't say like it's, oh, the company needs to be doing super, super well. It's about how you communicate your wins. It's about how you communicate your strategy and how you run your process. Now, yes, if the company's not doing well, if it's, I don't know, a bridge round, it's something that the company it's struggling, hasn't grown, it's hard to get one term sheet. So like at that point, you just gonna try to go and see what you can get. And it's a whole different topic for like a whole new
Different
podcast.
podcast. Yeah.
Uh, so it's a very different strategy, how to communicate with investor, how to be very upfront with them, how to, anyways. But for a company that is, growing steady or showing some wins, it might not be revenue growth, but there are wins in customer engagement on other KPIs. If there is a story behind it, a purpose in close to inflection point, they will most likely be able to raise capital and trying different strategies to get as many investors around the same time is what you want to do the best. But yes, this is for somewhat a company that is doing okay or good or really good, for you to even have that possibility to have multiple term sheets in hand.
Yeah. So, yeah, how do you do this really well? Where do you start?
Oh man, I can think of a few ideas from the conversation you had. Like we had three portfolio companies, two that were in our portfolio already raised their Series A and Series B very successfully because they ran a very effective and successful fundraising process. And then the third one was a company that we actually participated in the round. And similarly, they all had like 3 to 5 term sheets within a week. But what I would say is there's two pieces. One is before the fundraise actually starts, and one that is doing the fundraising. And I'm happy to go into details on each one of them, but I would say like before the fundraising starts, it's really creating a plan.
Yeah.
It's crazy. As crazy as it sounds, you'll be surprised how many CEOs or founders don't actually create a process of having like the responsible party, what's the task, what's the due date. And the reason why this is very important is because not only you set your personal deadlines, but also you start seeing where there are gaps, right? Like, oh, I'm gonna go from here and we're like, oh, but before that I'm gonna have to be able to create this file or create this pitch deck or create this. So you start seeing where the gaps that you need in the process. And most importantly, you can start seeing where you can ask for help, ask for support. And it could be team members, it could be your board, your investors, or colleagues. So a plan is extremely important. Then we have, what also is sometimes overlooked. It's just like a collaboration tool with all of your potential conversations or potential VC firms that you
Yes,
want to
prof.
meet. And it's super important. And you'd be surprised how many times we have even portfolio companies start the fundraise without one or without one that's actually helpful. And we push back and like, hold on, let's create like a Google sheet or something that not only the founder, the CEO, the executives there can collaborate and put some of the name of VCs that they already spoke in the past, that they know what they think, or but also your investors, right? Like, who are the investors that are really, really helping you right now? Because then you can all be on the same page on how to reach out to the VC. So, for example, I could go and say, the CEO starts this collaboration Google Sheet with like the firm name. Does this firm lead or not lead? What's the typical check sizes? Or do we have a warm intro? Do we already know them? And who is going to make that warm intro? And then what are the last, notes or last time we spoke? So that already helps everyone get in the same page. So if
Yeah.
the CEO starts there with like VC firms that they spoke in the past that they know of. And then after adding like some of the research that they've done to say, oh, these are the ideal VC firms that we would love to have in our table. So they can list them. And then your investors can go in and say, okay, well, let me see what you already have. And let me put more because all of your investors know a ton of other investors. So, for example, let's say it's a supply chain company. We invest in supply chain. And let's say we're supporting a series A for one of our portfolio companies, and the CEO goes and says Dynamo Ventures. Dynamo is a supply chain focused VC, and he's like, oh, I would love to meet with Dynamo. Well, I know that Dynamo does pre-seed and seed, so I'll put on that note like, hey, I don't think Dynamo will do series A. I know them, but it's worth me checking. So all of this is just allows like this collaboration. And again, the CEO and executive putting the contacts that they already have, putting their ideal investors in their minds, in us VCs or investors going in and like, okay, I can make these warm intros. I don't know anyone here, but I can ask. Or I don't know if this strategy, I don't think it's a good fit, or they don't lead, they lead. We know so much of like other VCs strategies because we meeting with them constantly in conferences, on calls. So it's really important to collaborate. So that I think it's a huge step as well. That it's sometimes overlooked or not done properly, and if it's not something that's really going to be helpful, it defeats the purpose. So those are two, like creating a plan, creating the collaboration tool. And I think while you are doing these before the actual fundraise, you can start some casual conversations as well. You can go back to investors that you know from the past or investors that you met when you were not fundraising and say, hey, I think I would love to catch up. I think we're going to be fundraising in a quarter or so. So we'd love to give an update on the business and also hear a little bit about your firm, if there has been any strategy change. And this is a great opportunity to like have like a preliminary qualifying call to really see like, is this a good fit for us? What are they looking for? Or getting a sense in the market of like, what are people looking for nowadays? Like, there's times that they want growth. There are times that VCs are more worried about cash efficiency because it's a tough market. So like, just having those casual conversations are super helpful while you are creating these preliminary steps to eventually start fundraising.
Yeah.
That's kind of
So
like before. So if you have questions like the before the official raise, these are
yeah,
some of the techniques that I think is just like getting structured, getting organized. And again, there could be so many things, right? Like you need to think of strategy, the message, and da da da. I'm only focusing here on the process of like
process.
how to run an efficient process.
Yeah.
Yes, nothing of this matters if you don't know how to tell your story in your strategy in a very persuasive way. But if we were to focus on the process itself to try to time it, these are little strategies that are helpful.
Yeah. How important is the role of investors in helping the startup fundraise at this point?
Um, I think it's extremely important. I think, VCs, us investors, we can't run the business for you guys, nor we want to, right? It's not our job. We can't get into the day to day. So we take board positions. We even if you're not board members, a lot of times there are VCs out there that are super engaged and talk to the founders frequently. And this is one of the moments that your investors, your current investors, can help you the most. I know sometimes people are raising like a pre seed or a seed round that don't have like institutional investors, but they can tap into angels or they can talk to other founders to see like if they have tips or things. But if you do have investors in a board, this is one of the moments that you can leverage them the most. Like one, your investors see thousands of deals and pitches every year. And then add that of like many years of experience, like they've seen it a many of these and they've helped a lot of their portfolio companies fundraise follow-on rounds. So they have that experience in perspective. I'm not saying that they always gonna have the right answers for every situation. That's not the case at all. But the role of us investors is to provide perspective, to provide other possibilities and feedback. So this is definitely something that you could be talking to someone that has more experience than you and seen many, many other outcomes and situations. Two, VCs also fundraise. So
Yeah, and
they
that's
know, like a lot of them know what it is to be sitting on their position. Yes, it's a little different, but like at the end of the day, we also need to have a CRM. We also need to be organized. We also talking to hundreds of LPs to get the feel that will invest in our fund. So a lot of times VCs also have that experience and can truly understand what you're going through.
and I
Um,
often hear that that's often a lot harder than raising capital as a startup.
Yeah, I don't know. I never raised capital for a startup, so I won't go and say that. But it is hard. I have to say, running our own process to raise capital, it's always hard. It's not super easy all the time. So, um, yeah. So, and then finally, I think a good reminder is that the VC wants the success of the startup as well. Like in, for the VC to be successful, their startups needs to be successful. So this is a time that they can provide a lot of value because of their experience in all the connections that they have. So leverage that because the VCs know about other investors. The VC have connections to many other investors that you don't have, and that warm introduction is makes a big difference in our industry. And even if they don't know, they can find someone else who knows, like so in our situation there was someone wanted to meet with Bessemer and I said, oh, I know someone from Bessemer from my Kaufman Fellows class. Sure. Send the email, that person puts in the right contact and that's where the networking and the introductions happen. And even if I didn't know, I couldn't go on my LinkedIn, see who in my network knows such that person and be like, hey, such and such, we have a deal. They're doing great. They would love to, connect with such and such. Would you mind making an intro? And it's sometimes a lot easier than coming from like a startup trying to like send a cold email to that investor. So
Yeah.
it's definitely one of the times that you can leverage your investor base the most because it's what it's an access that they have that you don't have. So it's extremely important to, that's why keeping a process that is well communicated with your investors, having a collaboration tool that they can also look in and see where they can help, and being very vocal of what you can what they can help. Like, you need to know what to ask for. It can really help you succeed.
Do all of your portfolio companies leverage you to help with fundraising as much as they should?
I think so. And maybe it's because they ask, or maybe because I just like, hey, hold on, I can help you. The Our approach, and it's not for every VC. We're very hands-on investors. So one of the things that we pride ourselves is really to help our companies beyond capital. So we typically leading, or even if we don't lead around, we take observer roles. So we're very engaged of what's happening on the firm. And yes, if they're gonna come and start fundraising, then we turn on that fundraising bucket, and we are helping them by reviewing their pitch, by offering to practice the pitch with them, um, offering these little things that sometimes they oversee, right? And then we tap into like the rest of the team. We have like four partners, two associates, and that's when I'm like, hey, this company is going to start to fundraise. Here's the blurb. This is the email I'm talking about. Or hey, they want an introduction to X, Y, and Z. I go to our CRM and I can see that Tim, my partner, has a connection there. Like, Tim, can you send this email to such and such? So like we spend a lot of time like really helping with introductions. And plus, after the intros, when companies VCs actually start getting serious about the investment, they actually call you and they're like, okay, well, Camila, thanks for the intro there. We really like what we see. This is the step we completed so far. Can we get on a call very quick? I want to hear more. So they want to know, like, how has it been to work with that founder on the board level? How has it been like as far as growth, and where do we see the company going? What is the growing pains? So there's a lot of calls that we take through that process. And like these two companies that I was talking about, I had several calls with potential investors to kind of sell the company too, but also be honest, because now it's my brand too. Like I can't go and be like, try to fake the growing pains or the challenges, because if that becomes the investor in the round, they're gonna have and see access to everything and see everything anyways, and be like, Camila, what did you lie to me? No. So it's like being very honest to be, hey, this is the part that is challenging. This is why I think you guys would add a lot of value. Or this is why this fundraise is going to change the course, because this money is going to allow them to invest in this area. So yes, there's our portfolio companies do leverage a lot of our help, both with talks to other VCs, a ton of introductions. We have like a wide range of network with four partners, so like very different backgrounds, various areas that we can touch and reach. So hopefully, we contribute a lot to that fundraising process. But
So
I do have to say, at the end of the day, who's pitching is the CEO, is the
yeah.
founder. So our help is in the back end. We can help that founder pitch, give feedback, and like, hey, it's not great. Hey, let's change the pages here. But who runs the company, who is really, really responsible for the success of the company, is the founders, is the CEO, is the executive team. And same with the fundraise. I won't go and like take credit. No, but we're there to really help along the way, to really help the founder think about all the different scenarios and have different perspectives. So yeah, we'll help as much as we can. But at the end of the day, there's a person there that is responsible to fundraise.
Yeah. So before you actually start fundraising, you're saying that you need to have like a clear project plan ready. Make sure that you have all your stakeholders in like your investors, and then you also have conversations early so that you get a sense of who are your right target of investors, and then you also prepare like pitch and stuff, practice other things. But once you start the process, like you said, the goal is to get multiple term sheets in the same week, right? So
Hmm. Yeah, I think once you start the process, I think there's two main things that you can control and or somewhat control. So you did your best in preparing and planning and starting some casual conversations. I think one first thing that you could control is the timing of when you're taking first intro calls. Aside from the casual conversations before you actually fundraise, you can have and say like, "Hey, I just wanted to give you a quick update. If you're interested, we're going to kick off intro calls on the week of the 15th, whatever." And if you are able to get a ton of those introductions from the VCs or emails going, you can always say, "Hey, we're finishing up the pitch deck and a couple data points, but we plan on kicking off intro calls on the week of such and whatever, 15th in the following." So like if you try to time that 2 to 3 weeks for just intro calls, you can have as many intro calls at the same time. So you at least get a lot of people started in the same time. And the other way that you can try to control, and this is actually was shared with one of our CEOs that when I was talking to him about the successful process that he had, he said your data room release was a way that we were able to control the timing as well. And it was funny because he said it was not intentional. We actually were just finishing up a few materials that we were like going back and forth. And last thing you know, it started to create this buzz of all these intro calls that he had had. And people are now talking to each other. I'm like, yeah, I met with this company and they're really interesting, but they haven't released data room. And then like started to create this buzz of, hey, who is this company fundraising? It's still like haven't like released the data. And that is another great opportunity, one of the very few opportunities that you have to control the process, because one, you start seeing who are the investors that actually are interested in digging deeper, because they're going to ask for the data room. And you can use the same thing. So like you want to keep that excitement, and maybe you send even like a quick email in between like, hey, just quick follow up, everything's going well, we're just finishing a couple things and I'll release the data room by this date. But again, releasing the data room around the same time allows the to at least get all the investors that are interested in digging deeper started along around the same time. After that, you have zero control. And it's a combination of luck, honestly, because you can have a company, like for example, it can happen to us. You can have a company that couldn't move fast, but is overwhelmed with 2 or 3 other deals that are already in super deep due diligence. And we just don't have the bandwidth to process that deal, right? So it takes a little longer for that firm, to longer than usual, to do that due diligence versus could be a firm that, hey, I don't have anything interesting looking like right now. And therefore, I'm going to go super deep on this one super fast, and now this company is like super quick into the process and the other company is not as quick. But so I guess it's like the timing of your intercalls and timing of when you release the data room. I think two tactics that are very, it's kind of like the only things that you can control from a timing perspective. After that, you kind of just need to like manage case by case and seeing like which ones are really interested. And I think what's always important, and I think actually it's a good sign of how well you work with the investor, is just keep them updated, because if the investor, so sometimes our bandwidth is sacrificed, like we don't have much bandwidth that month. But if the investor, and I see a deal that I like, I'm like, oh great, I love this deal, but they're super early in the due diligence process, where this one is late, I need to finish this one. So I will casually start that one, but not push too hard or too fast. But if that CEO comes and say, "Hey, Camila, just wanted to give you a quick update. We really like meeting with you guys. It would be great to work with you guys. So I want to keep you in the loop of what's happening. I have 2 other companies." Now, don't lie, please, because that we find out, right? But like I have 2 other companies that are actually in their investment committees meetings this week, and we'll probably be able to give a yes or term sheet within the next 2 weeks. Giving me that update of like how fast others are moving allows me to say, oh shoot, like I gotta move this fast if I really like this company, or I can say, I really can't. So we probably won't be, because I can be I'm very blunt with the founder. I'm like, I can be very blunt with them. I'm like, I will not be able to meet that with our
Deadline.
process and where I am. I'm too early in the process to pursue all of the steps that I require. But hey, go for it. Let me know. And I'll continue to do my due diligence, and maybe I come as a syndicate. But again, like, keeping your investors in the loop allow you to put some pressure on them, or to get the real answer from them, to see like, hey, I'm not going to lead. So don't worry. Don't wait for me for a lead. Maybe we'll come as a follow, So it allows you to get a little bit of answers from them of what's the expectation is.
Yeah, just some clarification around data room. So you're suggesting to release some parts of data room initially, or nothing at all when it comes to timing?
I would try not to send anything at all. I mean,
Okay.
obviously, when you have like the intro call, you have the pitch deck and some metrics. Um, but after that intro call, you can say, "All right, we're finishing up a few things for the data room. I will send it to you as soon as we have it available," and
Okay.
then send it kind of the same material, and then you can send a data room that it's like you can track who is going in or not. That's ideal because it allows you to really see the investors that are staying engaged or not. Or even if they don't get in, you can go and see the notes. Hey, just FYI, want to make sure that you saw the data room, and if you have any questions, right? But yeah, I try not to
Well,
release anything at all and release it all at once. Like, you have to have everything planned ahead of time to be like, okay, here's my 2 to 3 weeks for just intro calls. If they ask for data room, I can be like, hey, I'm gonna release in a week or so, I think, because I'm finishing up a couple things, and then release it all
but
to all of them, so they all have access to the information at the same time.
but will that be seen as a negative thing? It could come across as that, like, you're not prepared and you don't have anything in place before you started the process.
I see what you're saying. I think it all depends on the delivery. I think it depends of how you say, like, yes, thank you. Really enjoyed our call. I want to make sure this process is run effectively. I am finishing up a couple of details and getting reviewed by our board, and I will have this ready for you at this time. Again, I don't want you to wait too long. So if you plan it, if as much as you can, at least you release somewhat in a timing that doesn't lose momentum. But I do think, I mean, VCs appreciate that you're running an effective process, and you have the upper hand because maybe you're performing good. So you might as well use it. And I don't think VCs necessarily would look at, I think they would most likely look at it as a positive versus a negative. Because, okay, here's a CEO that knows how to run this process, that has control through the process, that is doing the thing the way it should be done. Like, is doing his or her best to run a successful fundraise. And it doesn't look desperate, like, oh, yes, this here. It's fine. I do like responsiveness. I'm not saying like, oh, someone send the email, say, hey, can I get, your projections or your data room? And then like don't reply for days to gain time. No, that's not how I'm saying. No, reply. Say, hey, love the call, really enjoy meeting you guys, yada yada yada. We are finishing up a couple things. We will release the data room at this date, and you'll be one of the first ones to receive it.
So two things. You're going through a list of investors that you prepared before the, as a preparation thing, right? So in what order do you go through the list of investors? And also, what is the goal of this qualification, intro calls?
So there are VCs that lead rounds, VCs that don't lead round. Typically, you want to focus or prioritize those conversations with VCs that are potentially going to lead the rounds. And then especially if you have like a warm introduction, there's a fit from a stage perspective and sector. Yeah, those are the ones that we know well. So like let's prioritize those because you have an in those really relationships. One thing I learned when I talked to a founder when we were talking about the process was he said, yeah, I mean, yes, having the conversation with VCs that lead is super important, but you will be surprised with how helpful a VC that comes as a follow on can really be in the process. And nowadays, you see a lot of emerging managers and VCs that don't necessarily lead rounds, but that's their strategy. And they've been doing this so well and execute so well that they, however, can run a due diligence and decide if they want to invest it very quickly, so they say I'm in. When you get when you have a lead investor, I'm in. But the interesting thing there is that these VCs actually know a ton of VCs that lead because they see a bunch of deals. They cannot lead. So they need to find a VC to lead so that they can get in. So, and they have a really good relationship with these VCs because once the syndicate needs to be closed, they want those VCs to pull them into the round, right? So, what I would say, like, I would typically say prioritize the ones that lead. That's the ones, and I still lean towards that because you do need a term sheet at the end of the day. But there are a few firms that also have very strong relationships with lead investors, and we know a few of them because they bring us deals all the time. They're like, "Oh, Camila, I saw this deal. We're in, and you decide." But I wanted to share with you because I know you could lead. Um, so I used to say like, oh no, let's focus only on the lead investors. Now after this process, I started to realize, maybe, there is a strategy here. Like there are a few um, follow on VCs that actually can help you finding that lead investor, especially if you a startup in a very early stage that don't have many warm connections to lead investors or ways to get to the lead investors. Some of these VCs will be able to help you get there. So if you convince them that you're a good deal, they will be able to give you a very warm introduction to a VC that could lead your deal. And they know those so well and their strategies so well. So like they're very targeted as well.
The other question was also like, what are you trying to get out of that intro call?
I think it's understand. I mean, again, I'm very focused right now on the process, right? On the efficient process, on timing, and trying to get that project management piece of the fundraising process
Yeah.
successfully executed. Obviously when you are meeting with VCs, you want to understand like beyond capital how they can add value, what's the fit, do they have sector expertise, can they introduce you to new people, to customers. There's so much value that other VCs can add based on their expertise. But here focusing on the process itself, I think there are a few things. What does your due diligence process look like? What's the timing? What are the steps? How many calls do you typically need after the investment committee meeting? Are you ready at that point to do term sheet, or is there more due diligence that you do? So really understanding like what are the steps for that person or that firm. Every firm is different. Some can do a very extensive analysis and talk to customer calls and talk to experts. They'll do cohorts analysis, look at all the financials. Others are not so thorough on their due diligence. So understanding timing, understanding if they lead investments or not, because then you can prioritize. Like maybe you don't necessarily prioritize the intro call. So you can start saying, okay, I only have one block on my calendar tomorrow. I'm going to put the one that leads versus the other one, right? So, do they lead your round, your stage? What are the check sizes? So to really help you move them along the best way possible.
Yeah. And what percentage of founders that you work with actually run this kind of very efficient fundraising process?
That's a great question. I think from our perspective, we try to run the this process with all of our portfolio companies, right? That's kind of like our playbook. We have different sh- things that we help for the C to Series A process, and this is something that we try to help our portfolio companies do. Sometimes they're in a position to do this and focus on the process more than anything. Sometimes they're not in a position to do that, and it's less about the process because they're not doing so well, or they're you know moved in a different direction, so they need to reset expectation. But I think they all start with needing help in some sense. Like, just okay, you started a collaboration document, but it's not really adding value. Like, let me help you, like, put the right columns and stuff, and the information we need so we can actually add value. And it's because it's hard, like, you are the CEO, you're the founder, you have very limited resources. You're leading sales a lot of times in the stages that we invest, right? Like seed stage. So you're leading this, you're leading partnerships, and now you just got another full-time job, which is to fundraise for your firm. And you have to talk about strategy. You need to talk about this. So it's like I said in the beginning of the podcast, is it's easy to forget, what's the process, project managing this. And that's why it's so crucial to do it and push them to do it, because then you can actually find maybe someone else in the firm that can project manage it, to be on top of people like, hey, did you do this, did you do that? But I don't know. I don't know if I have an answer as far as like an exact percentage of founders that successfully start with all of these. I think they all start with something, and the investors in the room kind of chime in and like, okay, let's also do this. Let's also add that. But recently we have those three cases that were very successfully run, and it's super exciting.
Also, is there any correlation between companies actually doing well, who are also the guys who run these processes very efficiently?
Yeah, I think companies that prepare and be disciplined on execution do really well. Like, what is that famous quote from Lincoln? Like, give me 6 hours to like chop down a tree, and I'll spend four like sharpening the axe. And it's because you need to plan. You need to create a project, create see all the pieces together to really think through of what's needed to be successful. Now execution is also everything, right? Like, you can spend hours and hours planning, but if you don't go there and execute, it's pointless. But in order to execute well, you need to have a good plan behind, and the discipline to follow that plan. So that's why I think there is a correlation. Yes, if someone can run a successful fundraising round, most likely they have the skills to run a business too. Like, not everything in a business, but like to be disciplined, to create plans, to be thoughtful, to ask help where it's needed. Now, obviously, a business has way more factors and functions and things that the CEO doesn't necessarily owns expertise in every single aspect of this, but it's again creating the plan, finding where are the gaps and where they need help, and asking for that help, at pulling the board when it's needed, to hiring that right person when they need. So I think there's a big correlation for sure. And obviously, the correlation the other way, like, if you're doing well, most likely you have a lot of interest from investors. So now it's just a matter of maneuvering the process so that those interest parties come in together at the same time. And like I said, sometimes you could be that, let's say Grand Ventures moving faster than they expected. And I might say, yeah, we have the IC meeting tomorrow and we'll be able to put a term sheet next week. If I'm the founder, I can go quickly to the other conversations that I'm having that are strong, that are potential leads. And as I mentioned, go and say, hey, I have another VC that said that they could be putting a term sheet next week. Just wanted to let you know, to really understand where you are in the process and see how we can help you move along. So you can communicate that with other investors that are in the same interest level, and try to time it. So if the company's doing well, it's a different conversation that you can have with investors for sure.
Yeah.
The only thing that I would add, and I don't think we touched on, it's so important to keep everyone on the same page of how we're thinking and executing. After you kick off the fundraise, a lot of the help from the investors, like, oh, we already helped you with reviewing your data room, reviewing the files, your pitch deck, practicing, making introductions. The companies that I mentioned, we would have almost like a weekly update with the board. Some of them started with like a 30-minute call on the calendar on Fridays that we can be like, okay, how was it? So you can start saying, like, okay, yeah, I had these conversations this week. It went well. These are the passes this week. And then us investors can look and like, oh, three of the four passes were due to traction or market size or whatever it is, that we can chime in and say, hey, let's get in a quick call just to discuss here. How are you guys presenting this slide? How are you presenting your market size? What are some complementary document that we can provide to really show our rationale why this market size is actually great and not this? So if you're constantly communicating with your investors so that people can chime in and help as needed. So, anyways, just having like a maybe a weekly update, rather that it's a call that can be canceled if there's no significant update, or if it's an email that is just a flash quick bullet points of like what happened in the week. It's super important.
This was great. Camila, thank you so much for taking the time to do this.
Yes, it was my pleasure. Thank you. Thanks for the patience when we were trying to schedule time here to do this. And I'm glad it finally happened. Thank you.